BJs Stock Analysis, what's going on, guys? That's what we're going to be talking about in this video here today. This is another stock kind of like that Walgreens stock analysis we did, where it's not a real sexy play per se. It's not going to grow hundreds of percent in revenue. It's not going to have growth estimates of 200% over the next 5 or 10 years, obviously. But it is a stock I looked into. It's a stock that I love for a lot of different reasons, but there's one major reason, which you guys might already know, and that's a real big risk in my mind, okay? And that's why I'm kind of staying on the sidelines with this one for right now. But it does interest me in a lot of ways, and we are going to get into that reason in this video, along with a lot of other things that I like and a lot of other things that I don't like. Hope you guys enjoy this video. If you do, if you don't mind hitting that thumbs up button, that really does help me out in a huge way. And I really do appreciate every single one of you that does drop a like on this video, because that helps me out more than you can even imagine. Also, if you have been enjoying these videos and you've been enjoying the content, don't forget to subscribe to the channel as well, because we do have more videos like these coming. 2021 is going to be a big year for this channel. You don't want to miss out. You definitely want to be around for all the great content we're going to put out in 2021. So, in saying that, let's get right into the contents, guys, and let's start talking about BJ's stock. This stock is under $40 at the time of me filming this. It's around a $5 billion market cap. It's known as the leading warehouse operator in the eastern United States, okay? They offer 25% more savings than most supermarkets. They operate 3 times the amount of clubs compared to the next warehouse operator. This company was founded in 1984, and they operate currently 219 stores across 70 different states. Of these stores, New York stores actually make up 25% of their net sales in the year of 2019. Now, all these buildings that they operate out of, they're all leased, so they don't own any of them. And at first you might be like, well, what happens if something goes wrong with the lease? What happens if it just all doesn't work out? Whatever the case may be. What if they can't operate in that building, right? Well, their leases run in most of their operations, in most of their buildings, through 2040. So there's gonna be no short-term fear of like operations going south or anything like that, because they have the leases set for another 20 years. They also operate gas stations, okay? I'm sure a lot of this is boring. I'm sure you guys already know a lot about this company, but this stuff's important. Just a couple of quick check marks here. Then we're going to get into the real like beef of this video and a lot of good stuff that's going to come in this video, okay? So like I just said, they operate gas stations. They operate 149 different gas stations. As for their products and sales and how they're broken up, in 2019, 27% of their sales were from merchandise. Perishables made up 32% of their sales. As for non-edible groceries, that made up 24% of their sales. General merchandise made up 17% of their sales. And in their stores, they have private label products, okay? These include Wesley Farms and Burke Jensen brands, okay? So those are the 2 main ones. These 2 made up about 20% of their total merchandise revenue in 2019. Now, let's just take a quick look at the balance sheet, and then once we get through that, we're gonna go back over to the whiteboard and we're gonna start getting into this, and we're gonna talk about what I like about this company and what I don't like about this company. So, cash and cash equivalents, 46 million, okay? Total current assets, 1.6 billion. Total assets, 5.4 billion. As for their revenue, 12.4 billion in 2016, 12.3 billion in 2017, 13 billion in 2019, and approximately 13.1 billion for fiscal year 2020. And for the trailing 12 months, 15 billion, okay? As for bottom line or net income, 24 million in 2016, 44 million in 2017, 51 million in 2018, 127 million in 2019, 187 million for fiscal year 2020, and for the TTM, 366 million. Now, long-term debt, 845 million. Of that long-term debt, only 260 million is current debt, okay? Current debt, so debt they're gonna owe really shortly. But here's something important, and this is something that the management team did that I really liked. Due to the recent increase in sales and revenue they had this year, the management team decided to pay down a lot of this debt, okay? That's really important for a lot of different reasons. They paid down the debt from 1.3 billion to 845 million. Now, why is that so important? It's important because what this does is allow them to unlock a cheaper interest rate, okay? So they're not gonna have to pay as much in interest as they would be paying when they had 1.3 billion in debt. So we're gonna start up with the positives, what I really like about this company and their business model. Then we're gonna get into like other things, the risk factors I see with this investment in this company. Then we're gonna end with that one really big factor that's turning me off from this company for the time being, okay? So to start, their revenue business model, it's diversified, okay? They have merchandise, perishables, all those other things that we just talked about, all right? So if one goes down the drain, they still have other things backing it up. So say merchandise doesn't do well one year, they still have perishables, they still have non-perishables, they have all these other things that make up a big portion of their model. Same thing with perishables. If that doesn't do well, they still have merchandise, they still have the gas stations, they have other things, they have other revenue models in that business model, okay? That's very important. I really like to see a diversified business model. That way you're not relying on one thing. So a good example of maybe a company that's not overly well diversified is Cirrus Logic, because about 80% of their revenue comes from Apple. So if anything were ever happen with their relationship with Apple, it wouldn't be good for Cirrus Logic, obviously, because then where do they go from there? 80% of their income just walked right out the door, so they have to figure something out, anything were ever to go wrong with Apple there, okay? Now, secondly, their business model, it's recurring. Well, kinda, okay? It's kind of recurring, but there's a portion of it that's recurring, okay? That's important. And why is a recurring business model important, or a recurring revenue business model, rather? Obviously, if you watched any videos in the past, I really like recurring revenue business models. And the reason is it's just easier to plan. You're like, all right, we see this much coming in, we're projected to get this many more customers, that means we're gonna have this much more income. It's just easier to plan rather than when you're selling a product, okay? Obviously, there's portions of their business model where it's not recurring, but there is a portion that is recurring, which I love to see. So fiscal year 2020, they made up about 302 million in memberships, okay? And they're growing. They have a retention rate of 87%. I love it. I love it. I love it. That means more and more people are coming back. It means more and more people are coming in. I love it. I love that number, okay? This number, the 302 million, that's also grown each year for the past 2 decades, okay? Just to go off some numbers here, 2016, this membership income, 247 million, 2017, 255 million, 2018, 258 million, 2019, 282 million. I finally got some new markers for you guys to look at so you're not just watching me write with something you can't read. I hope you guys can see this okay. If not, I have more markers on the way, so hopefully something's gonna get us working here with this whiteboard, all right? I actually kind of want to get a bigger whiteboard, but that's besides the point. Anyway, back to the point of the video. This membership rates, they're supposed to see a 7.7% compound growth rate, okay? That's very important. That's a pretty good rate. That's a pretty solid rate. That means more and more people are coming in, like we talked about. Very important, okay? Customer traffic is very important. More customers equals more money, okay? We like money. We like revenue. Very important in business. Very important in stocks, okay? Additionally, they've seen a 10% increase in membership renewals so far this year, which means, like we talked about, almost everyone's coming back and more. Okay, everyone's coming back and more. That's huge. I love that. I love to see this customer traffic. And this got me really, really excited when I first started reading about this business model. I was super excited about it. But wait, there's more. Now, additionally, the big thing that I really like here, in addition to everything else we just talked about, they want to add more stores. What does that mean? More stores equals more products. More products equals more people. More people equals more money, okay? Print that money. That doesn't really apply here, but I really wanted to throw it in there somehow, right? So they're opening more stores, okay? And a lot more stores, right, guys? Okay, a lot. They opened up 2 more stores this year, right? They want to open up 2 more in New York in January 2021, okay? Then they want to open up 6 more in addition to that in 2021. And in the conference call, they talked about that they see a pathway where they can open up, wait for it, 10 stores in 2022. 10 stores. That's huge for this company, okay? Then in addition, the management team, okay? Very important. So if you ever want to look back at a company and see if it's really a good management team and it's worth investing, go back to a time of crisis and see how they managed it. So I'm guarantee you a lot of people are going to go back to 2020, look at the management teams from a lot of companies and see how they handled it, okay? This management team handled it phenomenally, okay? So they had to adapt during a once in a 100-year event. They expanded to digital channels, right? They had more than just going into the store and buying things, right? They had digital, they had same-day delivery, they had curbside, they had all of these things going for them that they basically had to adapt to overnight. And keep in mind, in this previous quarter, digital sales grew over 200%, guys. They grew over 200%. That's a lot of growth for something that they really haven't had that long. And in addition, and this might seem a little counterintuitive, you might be like, what are you talking about when I throw this one out there? They don't pay a dividend. And you might be saying, isn't a dividend good? You're getting more money. Here's the thing about dividends, guys, right? If a company pays a dividend, okay, whatever, perfect. But I don't mind when companies don't pay a dividend. And why is that? Because when a company's paying you a dividend, they're taking money off their balance sheet. They're taking money off their cash and they're giving it to you. And you might still be saying, what are you talking about? Why is that a bad thing at all? Well, it's not, right? Or is it? So that money, first of all, can go back into the business, right? They can use that money to open more stores. They can use that money to do some marketing. They can use that money for a lot of different things, guys. It's not as easy as just giving you money and they just have more money coming in. There's a lot more better places that money can go, in my personal opinion. One place could be share buybacks, right? So this past quarter, BJs has done $50 million in share buybacks, okay? $50 million, all right? That's a lot. Year to date, They had $88 million in share buybacks, or 2.3 million shares. That is a lot in share buybacks, guys. That's a lot. And in addition to this, and I don't have this written on the board, I probably should have written it up here, but I just thought of it right now off the top of my head. I don't know why I didn't include it in this, but they want to expand outside of like the Northeast, the Eastern area. So that means they're going to be attacking more markets, and this is going to be bigger for like travelers, right? Because think about it, like me personally, if I go to like somewhere, I'm from Rhode Island, if I go to like California or something like that, I'm going to like Walmart or some Rhode Island like based grocery store. I'm not going to go to any of these like, Kroger or anything like that, which we don't have around here, but I'm just not going to go to that because I'm not familiar with it. I'd much rather go to Walmart than a grocery store. I just don't know. That's just what I would rather do personally. And I'm sure a lot of people are like that as well. They're not going to want to go to these weird stores they never heard of. They're going to want to go to the basic ones that they're comfortable with. And in addition to all this, it trades cheap. It trades cheap, guys. Look at some of these metrics here. Forward PE of under 15. PEG ratio of just over 1, price to sales ratio of less than 1. All right, guys, so now we're going to talk about some of the risk that I see with this stock and this investment. And obviously, it's an investment, so there is some sort of risk. Like we talk about in so many different videos, regardless of whatever you do with their money, there's going to be a risk, okay? There's obviously a risk reward, and you just have to decide if the risk is worth the reward. Whether that's keeping it in cash, real estate, stocks, that's up to you to decide. That's not my job to decide. So, some of the risks I see with this company, first and foremost, it costs money to shop there. It's not free to shop at BJ's. You got to pay for the membership fee. It's $55 for the Inner Circle membership fee, and it's $110 for the BJ's Perks membership, okay? So, what if people can't afford that? What if not enough people can afford that when the world gets back up and running again for whatever reason? They got to start paying rent again. They got to start paying their student loans again. They can't afford that $55 or $110 to shop there. What if they can't, guys? And that can be a lot for some people, especially that are living paycheck to paycheck, right? Think about it. That could be a 2 weeks worth of groceries if you go to Walmart or somewhere where you don't really have to have a membership to shop there, right? Think about that, guys. That's very important. Now, in addition, low prices, right? They have low prices. Like we talked about earlier, they have about 25% savings for all the customers that shop there, right? 25% savings. What happens if like Walmart and Costco, what happens if they come out and they're like, you know what, we're able to improve our margins, we're cutting prices, and they're matching BJ's prices? Why would you ever pay to shop there? If you can get the same thing at Walmart than you can at BJ's, it's the same exact price, there's no difference, but you have to pay to shop at one, you have to buy a membership to shop at one, you don't have to shop at the other one. Why would you ever do that? Ever? Think about it. It's just throwing money into a fire pit. There's literally no reason at all, unless you have like some sort of sentimental attraction to one of the two. But there's really, in my personal opinion, there's no reason to just not shop at Walmart if both are the same prices and everything is the exact same. Okay? That's something you got to think about. What if that happens? What if Walmart comes out and does that? Think about that, guys. You've got to think about that. In addition, the gas sector, okay? So what happens if gas goes up? Obviously, this is not the biggest sector of their business. Actually, this is the least important one, but it's part of their business and it's stuff we got to take into consideration, okay? So what happens if gas goes to $4 a gallon? What happens? Obviously, if their margins aren't going to be as good, they're not going to bring in as much money. That's going to affect their business. It's stuff you got to think about, guys. In addition to that, electronic vehicles. How relevant are gas stations going to be for the next 10 or 20 years, okay? Obviously, short term, nothing's going to be affected, but we're investors here. We're thinking long term. We're not trading, we're thinking long term. So obviously, Teslas are on the come up, right? Like we talked about in so many different videos, you're going to see more and more electric cars coming out. I wouldn't be surprised if in 10 years, maybe 7 or 8 out of 10 people had some sort of EV, okay? I would not be surprised at all for so many different reasons. Like, you don't even want to get me started, okay? That's for a different video, but I would not be surprised to see that at all. And it's something you got to take into consideration that can really affect their business. Are they going to be able to innovate? Like, what are they going to do with gas stations? How can they break even? Very important, okay? Now, here's another one that I don't think people are taking into consideration. I don't think people are thinking about too much. So BJ's obviously uses gas, diesel, fuel, etc., all that stuff. Well, and this isn't any political ties at all. We're just talking about the facts here. Biden, obviously, unless you're living under a rock, Joe Biden is going to be our president in about a month or so, right? So he wants to put in a carbon enforcement mechanism. What does that do to BJ's? What does that do? It could hurt their margins. It's going to cost them more money to operate. All these things are going to have to be taken into consideration. What if Biden comes out and he does that? Obviously, their business is going to be affected and it's going to cost more to maintain everything. Very important. Very, very important. I actually have a very strong concern about that. That's one of my bigger concerns on this list. It's not the biggest one, but I do have some great concerns about that. Now, another thing, employees are working from home right now. I'm working from home, you're probably working from home. Everyone that probably who watching this video is working from home, unless you're some sort of frontline worker, which if you are, thank you for everything you're doing for us in this very dark time of the world. But Anyway, so most people are working from home right now. And obviously, when you don't go anywhere, you don't need to fill up your car with gas. That's not an argument. That you can't debate that. When you don't drive the car, you stay put. You don't have to put gas in that car. You don't. So obviously, in turn, their gas revenues are going to be hurt by that because not as many people need to fill up. Not as many people need to go places. Not as many people need to get gas, all right? Very important to take into consideration. And one day, the world is going to turn back to normal, okay? Everything's going to go back to normal. You're going to be able to go to the mall without a mask. You're going to be able to go to the mall, actually. But anyway, the point is, what if people don't go back to work? Think about it. Obviously, teachers are going to go back to work. You know, waitresses, when restaurants are shut down, they're going to go back to work. Some people are going to go back to work. If you're working in a cubicle, in a desk job, there's a very good chance you might not go back to work. I mean, a very good chance. And in my personal opinion, there's no reason to. There's no reason to go back to work. Think about it. You're not seeing those people every day, so there's not as much tension in the office. There's not as people being like petty or just all upset with each other all the time because something happened. When you don't see them every single second of every single day, you don't get into arguments like that. So the office life is better, first of all. Second off, you have more time. You guys know time, in my opinion, and should be most people's opinion, time is the most invaluable asset because once you used your time, once that time passes, you never get it back. You never, ever, ever get your time back, ever, okay? So you get more time. You don't have to get ready in the morning. You don't have to drive an hour to work. You don't have to drive an hour back from work if your commute's that far. But you save all of that time just by working from home. You can, if you clock in at 8 o'clock, you can literally roll out of bed at 7:50, walk over to your desk and start working. As opposed to maybe if you have to drive 30 minutes to work, you gotta get up, you gotta get changed, you gotta look nice most of the time. All these different things, all this time's wasted. And sometimes by the time you get to the office, you're fried, you're burnt, you're done. Because you just had such a stressful morning. You know, you thought you're gonna be late, you got up late, all these different elements as opposed to just, oh, 7:50, let me just go right over to the computer, start working, right? Important, very important. You can also work in a different state. I know me personally, I went away a couple weeks ago and I worked. I was able to work. I had that luxury because I'm working from home and it was great. I loved it. I didn't have to use any vacation time. I didn't have to take any time off. I could just work. And then when I was done working, I can go enjoy myself. Now, another thing. Obviously, grocery sales and sales in general are up this year. Like Walmart, Costco, very good sales this year. Amazon's another one. What if that doesn't stick? BJ also has good sales this year. They also have very good sales this year. They're doing record revenues. What if that doesn't stick? What if the numbers, you know, the merchandise, the perishables, all those numbers start to go down once the Rona disappears? Because obviously people aren't going to stock up as much because they're not going to be as afraid to go and grab, you know, some cereal when they need it or some fruit when they need it. What if those numbers don't stick and they don't stay at their all-time highs and they continue to grow? What if they decline or maybe they're flatlined? What if that happens, guys? It could very well happen because the world's going to return to normal and this is not going to be a common situation. So what happens then? Do these sales stay the same? Do they go up or down? It's things you got to take in consideration and things you got to consider. Now, do I think that one's going to happen? I don't think that's going to happen because as we talked about, they're opening more stores. More stores equals more money. But it's something you got to take into consideration, okay? And on that same line of opening up more stores, what if they can't open up these stores effectively and efficiently and operate them as they plan to, as it's written out, right? So BJs has only opened up one store at a time, right? Each year. This is the first year that they've ever opened up more than one store. Ever, okay? So that's very important to take into consideration. They want to open up 6 next year and then potentially 10 in 2022. Think, what if they can't do that effectively and efficiently? That could mean very bad things for their business, guys. Do I think that'll happen? Based on the management team and how I've seen them adapt and what I've seen from them, no, I don't think that's gonna happen, but it is a risk and it's something to take into consideration. Now, the last thing we're gonna talk about before we get into that really big concern I have is just I calculated the intrinsic value and I did that out for you guys, okay? So, earnings per share, and if you don't know how to do this, I do have a video on my channel I made a couple weeks ago, so just go and look at my recent videos and you'll be able to find it. So, earnings per share for the trailing 12 months, $2.65. Growth rate, according to Yahoo Finance, this was not my calculations, this was Yahoo Finance, 21%, which I can see being close to that with the new stores and all of this, assuming they are able to execute on all those things. I could see 21% as being very realistic. Rate of return, I put in 15% because as we talked about in that video I made, we're picking individual stocks. So we're taking more risk, so we want bigger returns, right? We don't want that 7, 8% we can get in an index fund, okay? We want that 15, 20, 30% return, right? But we'll go with the lower end here. We'll go with 15%. Margin of safety, I put in at 50%, all right? And then the PE ratio, 14.5, okay? Again, that you can get that on Yahoo Finance, all right? So earnings per share, due to my calculations, year 1, $2.65. Year 2, $3.21. Year 3, $3.88. Year 4, $4.69. And year 5, $5.67. Okay? Some might think those are a little aggressive. We'll have to wait and see. Okay? So year 5, $82.21. That's what my calculations come out to 5 years out, assuming all this goes according to plan. Year 4, $71.49. Year 3, $62.16. Year 2, $54.05. And then this year, our fair price for this stock is $47. Okay, that's the fair price. That if we bought it today, that's a fair price. So, but there's one important thing we didn't take into consideration here: the margin of safety. So how do we get this? We'll take 50% of $47, and that gives us $23.50. There we go. So remember, this is a $38, $39 stock. It's almost $40 at the time of me filming this. So that means you're not taking that 50% margin. You're taking that 20% margin of safety. So if that's enough safety for you guys, that's up to you to decide. But I just wanted to show you guys this, kind of like how I run numbers on a stock that I'm looking at, seeing if these numbers are realistic, first of all. If they're not realistic, I throw it right out the window, and I don't even think twice about it. But I think it's pretty realistic that BJs can reach $80 in the next 5-10 years. I do think 5 years is very realistic in my personal opinion. I could see the stock doubling, assuming they execute on like those stores we talked about. I could definitely see this stock doubling. But now, let's talk about the big risk I have, okay? And that big risk is, I don't know exactly how much of the market share they're gonna be able to grab. Think about it. Walmart's huge, Costco's huge. All of these competitors, it's a very competitive space, all right? And then you take into consideration like other things, like you got like Best Buy for their electronics, you've got Verizon, all these different things that they sell. It's a very competitive space. And to be perfectly honest, I don't know how much BJ's is going to be able to capture. And for that reason only, I'm 50-50 in this stock, okay? I'm very 50-50. I kind of want to buy it. I see a lot of things I like, but I have these risks that we just talked about and that big risk where I don't know how much of the market share they're going to be able to buy. I'm very confident they're going to grow revenues. I'm very confident these stores are going to work out. There's a lot of things I'm confident in, but that big risk, I don't know how much exactly they're going to be able to take of the market share, which leads me to being 50-50. And if you're 50-50 like that, it's not the stock to buy, all right? You got to be like 90-10, all right? You got to be very confident before you buy a stock, or at least I do, okay? If this stock falls, don't get me wrong, if this stock falls to $20, $25, hey, I'm feeling a lot better. I'm feeling a lot better where I'm buying, and this is a lot more attractive, okay? This valuation, it's very undervalued. I think it's undervalued right now, but if it goes to $25, it's extremely undervalued, okay? Extremely undervalued. I think they're gonna have a great Q4 earnings because of the virus and just the holidays, because the holiday seasons are usually better for them. But like I just said, right now I'm very 50-50, so I'm gonna stay away, I'm gonna sit on my hands for now, and it's one of those I'm gonna monitor, all right? I'm very familiar with it. I understand the business model very well. I like the business model. I just have all those concerns, and being 50-50, I just gotta wait a little bit and see what happens with this stock. So that's my take on BJ stock, guys. I hope you guys enjoyed this video. If you do, make sure you hit that thumbs up button. That really does help me out in a huge way. I appreciate every single one of you for watching. I don't know if you're gonna see this video on Friday or Saturday. It's gonna be one of the two. We'll have to wait and see. But again, if you also enjoyed this, remember to subscribe to the channel. That also helps me out. We're coming up on 300 subscribers here. It feels crazy. I feel like just a couple months ago or a couple days ago, it was just, you know, me talking to no one. That I had like 10 subscribers. So the channel is starting to grow, and I'm really excited for what's to come. Anyway, guys, thank you so much for watching. Happy holidays. Hope you guys spend it with your family. Stay safe out there, and I'll see you guys in the next video.